SPYI ETF, the powerhouse of income funds. Should you drip or not drip? Does it really make that big of a difference? Let's dive into it today. What makes SPYI so unique? Well, SPYI combines S&P 500 exposure with a covered call option strategies to generate consistent monthly yields. Not guaranteed yields, but basically the potential of consistency in your monthly payouts. The core strategy is an actively managed ETF with a dual approach to maintain full exposure to the S&P 500 and generate tax efficiency income. The option strategies is to sell out of the money call options, purchase long call options for protection that creates a collar or a spread structure. So the covered call option structure is written and sold call options to generate that premium income. The long bought call options limit its downside risk, and the net credit position is premium income that exceeds costs. So they do some unique things in this whole package of SPYI. That's why S&P 500 ETFs are all different. They all operate differently. And this just shows how NEOS has a little different application. Now, I do have to say past performance does not guarantee future results, and this information provided in this video is for educational and informational purposes only. It should not be considered financial advice, as I am not a financial advisor. I am strictly a retail investor. Examples and suggestions discussed are just instructive and don't fit everyone's individual situation. Always consult a licensed financial advisor or professional before making financial decisions. So let's take a look at the performance and the overview of the fund since its inception. So this fund launched in August 30th of 2022. So it basically has a couple years under its belt that it's been through some troubled times, it's been through some good times. And you can see that the performance over the past 40 months is actually up 6.38%. And growth is not its number one factor. Income is where it really comes into play. So, but it's given you that steady growth over time, even with the April drop off. And we look at the screen now over the past 12 months. You see that April huge drop off. Every fund out there has seen that same exact thing. And now it came out, it recovered, has recovered well, back up to normal trends, and has done fairly well across the board, even with the current announcement of different tariffs that they use as scare tactics now. It's able to produce and generate some still 1.22% total return over the past 12 months. Distribution history, monthly average is about 51 cents per share, or $6.51 per share over the past 12 months. The only drop off that we've really had was at April 2nd again, and it recovered right back to where it was. So consistent distributions, which is the great potential for that. Price has recovered as quickly as expected, and the fund recovers quickly in market adjustments. Now, we told you just growth is 1.22 in the past year, but distributions were at 12.04%, which gave us a total return of 14.14%. We see the drop off we got in the negatives in April, but again, that recovery, long term. This one has the income and growth package built into it. Every time the thing has a slight drop off, it recovers back. And we expect the same thing here after the Greenland announcements. We're going to see this thing recover back again. Now the question I had, and this is where I started doing some research and math and said, should I drip this fund or not? I personally own SPYI, and I personally don't have it on a drip. And I get so many questions and comments of people is, should we drip this or shouldn't we drip this? So that's why I started thinking about this video and saying, well, first off, let's find out what SPI is about, which we just explained to you. Now let's go deeper. If I took $500,000 into S&P 500 SPYI and say, what would it look like 40 months ago? Back up history. Let's really take a look at history and get some real technical stuff into this. So I said, let's put in $500,000 into the investment. We would have been able to buy 10,177 shares at $49.13 per share. At 100% drip, and if you don't understand what drip is every dividend payment that I got, I'd buy more shares. Take every dollar that they paid me, buy more shares, and keep rolling it every single month. Month in, month out, month in, month out, all the way through. I would have been able to add 4,873 additional shares over the past 40 months. That gave me a portfolio growth of 59%. And I would get a average distribution of $6,233 over those past 40 months. My portfolio value starting off at $500,000 is all the way up to $800,000 over those past 40 months. So the maximum reinvestment strategy accumulated an extra 4,800 shares. The portfolio grew to 59%. Distributions actually reached $7,000 and continuously growing in only 3 years. So in June, July, August, September, we started hitting that $7,000 point, and wow, we're really cranking out some big distributions. So if I stop now with the 100% drip after 3 years, I could generally say I'm getting $7,000 a month from the portfolio. That actually works out to an average of $6,233 in growth. And it's building phase before drawing down. So if you're in the what I call pre-retirement, if you're into pre-investing, 3 years or more out, this is a good way to 100% drip to grow your funds fairly quickly in a particular fund. Now I switched it over to a 50% drip. So this idea is this: if someone is just starting into retirement, or they've gotten into it and they're collecting their Social Security, do you really need to grow your portfolio? Well, you need to continue to have some growth to make up for inflation, but would it be worthwhile in dripping 50%? So taking half of the distributions for yourself and the other half pouring it into the fund. So I looked at it again, and the structure came in. There was some different numbers. It was very unique. And I said a 50% drip would give you a total income over those 40 months of $112,000. That's roughly $2,800 a month that you could take in as income. Your portfolio would grow about 31.5%. And you will have accumulated an additional 2,269 shares over those 40 months. So your income would be slowly growing bigger and bigger over that period of time. So a 50% drip, you're pouring $112,000 back into it without adding any extra money. You're just pouring $112 back into the fund, and you're able to take out $112 into your pocket over those 40 months, which is about $2,800 a month. So is that good enough to retire on? Well, if someone's on Social Security, adding that together, possibility. So I thought this was a great piece of 100% drip if you're pre-retirement, 50% if you just start into retirement, of a balancing yourself, making sure you're well established. Then I went to the one that would fit me personally. And this one I sat down and said, okay, how would it do for me? The guy's been retired. I'm deep into retirement. I just want income. Took that $500,000, poured it all into SPYI, and I said, how would this do? First off, my distribution history would stay about $5,000 per month. So pretty steady across the board, which is a great fund to have in a retirement account. The portfolio actually grew by about 7% or $37,000 over those 40 months. So, and my income in total of the last week of it was up to $5,326, just strictly because the dividends were different. So across the board, here's a way of putting $500,000 away, collecting about $5,000 a month for a $60,000 a year income. Could that pay off and could I live off of that? Probably. I mean, I could probably do that personally. But the key factors I looked at this was high income, low growth. There's no big windfalls, just a pretty steady income. Income versus principal. The higher yield means larger distribution checks. And the risk return balance, the zero dripping offers a higher income but lower return. So you can just see everything's pretty much stays flat across the board. So is this a way of doing it? Definitely. Would I like to have a little more than $500,000 just in this particular fund? Most definitely. I think this fund would be a great one to be a part of a total package. So I don't think this is just one fund to set and be done and say I bought my fund and be done with it. There are a lot of things when it comes to retirement portfolios that I think you need 3 steps to do it, 3 buckets. And I'll put a video at the end that I did. It was about 3 bucket procedure of how to put a portfolio together for structuring that. So overall though, I think this is a great fund for what we're talking about. Now, as you know in the channel, we always talk about total returns. So let's do a comparison here of the total return comparison over the past 40 months. If you 100% dripped, your total return would be about 59%. 50% drip puts you about 54%. 5% difference. I was shocked at that number, that 50% to 100% is only about a 5% difference. And then at zero drip, 48% is still a very nice number compared to a 50% drip and a 100% drip. This is why when you get into why people talk about retirement on this is depending on what part of retirement you're getting into, is if you're, pre-retirement doing 100% drip, and if you just started in retirement doing a 50% drip, and if you're just already into retirement having a zero. This is different from every person, every establishment of what you want to do with your investments for getting ready for retirement. But across the board, you can do a lot of different things with these structures to try to achieve a goal that you have established. Now, tax efficiency and the Section 1256 benefits. SPYI's tax advantages enhanced after tax returns through the Section 1256 contract treatment. Now, I have to say right off the bat, this is where you start contacting your tax people. You talk to a tax expert. I have a CPA I can email immediately. Now, I'm not saying you have to have that, but it's just one of these things that you can understand the tax side of things prior to. Now, SPYI tax treatment uses option contracts that qualify for Section 1256 contracts. And if you don't know what those are, briefly, they're 60% long-term capital gains and 40% short-term, and the taxed regardless of the holding period. So the advantages for the higher tax bracket investors is using this system. It's an advantage to everybody, to be honest with you. So the traditional income ETFs normally put out ordinary income, and the standard capital gain rates will apply. That's less tax efficiency. So this is one of the advantages SPYI uses. Now, when we talk about this, again, these are different things that works in everyone's different situation. There is no one saving grace either way, but it's definitely an advantage that they have over other companies because they qualify for that 1256 contracts. Now, the real world monthly income projections, the current investors historically generate $5,000 to $8,000 monthly distributions based on the accumulated share growth patterns. I showed you multiple different ways in this one, so it really is kind of a round, big target that we're sitting at. It depends on how much money you're investing versus how much money how much you're dripping, how much you have dripped, and so on. But overall, this has been a piece for its potential for retirement investors, retirement accounts. It seems to have worked well across the board for many different people in the retirement periods, if you're starting off or if you're into it or deep into it like myself. So it's really, there's potential here across the board. Now, the portfolio integration and diversification strategy, SPYI works best when it's in an income component in a diversified portfolio. So if you really sat down and thought about this and said that equity holdings, which is the S&P 500 exposure for growth, so something that's really trying to grow the S&P 500, you could then put SPYI into as a income generator component. Then you'd also want to add in a fixed income for like bonds for stability and alternative investments like REITs and commodities to fill out your complete portfolio. Because SPYI is an income generator in small allocations. It's balanced with broader market exposure in the strategic part of it. And for risk management, SPYI's drawdown protection that they have installed into it that we talked about, and then the enhanced downside protection, it's just a kind of a package that you can't put it in the fixed income area. You have to put it as an income side of it in a portfolio. And this is why I always say you can't really just retire on SPYI as a whole unless you have put a ton of money into it. But it's a great piece to have in part of a multiple bucket retirement package. And I'll post the video at the end of exactly what I'm talking about as a video. So our key takeaways: the fund has an exceptional yield. As I said, you're looking at about 11% in dividends plus a growth factor. You're also taking a look at a unique strategy of a covered call approach. And you're going to have those, you can control your income by customizing your drips. I showed you 3 systems: 0, 50, and 100% drips, depending on where you're at in life. Downside protection, we really didn't talk too much about this, but there's a maximum drawdown. With the way they've set things up, is that SPYI has that about a 10% drop off. So what it really says is the maximum drawdown is normally no more than 10%, while SPY is about 55% because there is no protection, while SPYI is actually using some protection for that. And tax efficiencies have been huge. So guys, let me know what your thoughts are. Let me know where you feel that this fund, is SPYI something that you have in your portfolio? You're happy with it? Not happy with it? As I said, I have it in my own portfolio. It's in my retirement portfolio. It's what I use to generate income to live off of, but it's not the only one in my fund. Let me know in the comments below, especially if you like this type of video.
Thank you for watching. Press the like button, hit the subscribe button, and join. Leave any comments